Welcome to episode 33 of the Mango Monkey Show, where I'm here to help you guys understand more about money, to invest, and build wealth. In today's episode of the show, we will talk about the main types of share market investments. If you stay until the end, I will also give you my thoughts on which investments I would personally choose. Share market investments can be largely categorized into three groups. Number one, ETF, which stands for Exchange Traded Funds, which is also called an index fund, because the fund manager tries to mimic the index. It may not exactly have all the companies that make up the underlying index, but it should be very close to it. In Australia, there are three large ETFs. One is the Vanguard Australian Shares Index ETF. The code for that is VAS. This ETF mimics the Snp Asx 300 index, which is an index of Australia's biggest 300 publicly listed companies. It is weighted by the market capitalisation of the companies. In other words, the bigger companies make up a bigger proportion of the index. As of March 2020, the index accounted for 84% of the Australian equity market, with the two biggest sectors being financials, the banks, and materials, the mining companies. As of 30 June 2020, the total fund under this ETF is around 5.5 billion Australian dollars. Moving on to the second ETF. The second ETF is the SPDR Snp Asx 200 Index. The code for this one is STW. This one is Australia's first ETF and used to be the biggest. As you can gather from the name, it tracks the Snp Asx 200 Index, which is an index of Australia's biggest 200 publicly listed companies. It is also weighted by the market capitalisation. As of 30th of June 2020, the fund being managed by this ETF is around 3.7 billion Australian dollars. The third ETF is the iShares Core Snp Asx 200 ETF. The code for this one is IOZ. This ETF also mimics the Snp Asx 200 index. As of 30th of June 2020, the total fund under this ETF is around 2 billion Australian dollars. In my opinion, it does not matter which ETF you choose, as long as the size of the fund is large, which means it should be quite liquid, meaning you can sell your position very quickly. This also means that even if you need to sell $1 million worth of stocks, you are likely to be able to sell it within the same day without having to lower your selling price. The performance of those three very large ETFs are approximately the same, and the fees are more or less negligible compared to the investment return. These funds only charge around 0.1% per annum. When someone talks about ETFs, they don't necessarily refer to these big fat ETFs. There are a lot of ETFs which track highly fancy indices. However, unless you are an experienced share market investor, you probably don't want to invest in those. So for this show, when I talk about ETF, I really mean one of those three that I mentioned before. The only exception I have is if you invest in some kind of index through one of the new tech investing platforms like Raise or Spaceship. Even though those are not ETFs, they act a bit like ETFs and they allow you to invest with a tiny amount of dollars. In another video, I will go through these apps in detail. But with these apps, you can invest with as little as perhaps $1 or $2. So that's a great way for you to start investing into the stock market, even if you do not have a large amount of money to play with, because they charge almost $0 fees. Now let us talk about the second type of share market investment, which is a managed fund. ETF is actually a special type of managed fund. It is a managed fund which is listed on the stock exchange, and you can buy that without talking or sending an email to anybody. On the other hand, the usual type of managed fund requires you to fill in an application form, and at least send an email to somebody on the other end before you can start investing into the fund. There is a fund manager who manages the fund on an active basis. They spend all day every day monitoring the market to identify high-performing companies, and as a result, the good fund managers can perform better than the market average. Because of this, the fund manager can also charge a higher fee, often around 1% per annum, and also on top of that, they charge a performance fee, which is usually between 10 or 15% of the outperformance against the benchmark. And there is usually also a significant buy and sell spread. This means if you buy into the investment today and you sell it again tomorrow, you will be losing money due to the buy and sell spread. A managed fund usually still have a benchmark index they want to compare against, but the composition of the fund at any particular time can be quite different from the composition of the index being benchmarked. The third type of share market investment is, of course, individual companies that you choose yourself. This is where you choose your own companies to invest into. You can buy some shares in your favorite bank, for example, the Commonwealth Bank of Australia, the National Australia Bank, and so on. And then you can call yourself a bank owner. If you invest directly into these companies, you will receive a dividend whenever those companies pay a dividend. On the other hand, if you invest into a managed fund, there is a chance that the fund manager does not pass on the dividend to you immediately and use the cash to reinvest into the share market. You may have heard of a highly successful investor called Warren Buffett. With a net worth of over 80 billion US dollars, he is an advocate of ETF or index fund investing. The reason is that unless your fund manager is really good or really lucky, he is unlikely to consistently outperform the market index over the long term. Sure, he may have 1 or 2 years where he performs much better than the index, but eventually he will have a bad year, and on a long-term average basis, most fund managers cannot beat the market index. So according to Warren Buffett, you are better off minimizing the fee that you pay to the fund manager. With an ETF, most of the investment decisions are done by a computer. So the fund manager only charges a tiny amount, something like 0.1% per year. This contrasts to 1 or more percent for an active fund manager, even if the investment does not perform well. Just as the power of compounding can work in your favor to boost up your investment returns, it can also compound the fees that you pay as a result. If you consistently pay 1% more in fees per year, the impact after 10 years is so much more than 10%. Therefore, with this in mind, unless you know a highly successful fund manager who has a track record of consistently beating the market, you want to choose an ETF over an active managed fund. You may ask, can I choose my own companies instead? Well, a full-time fund manager cannot beat the market. So if that's the case, what's the likelihood that you can? After all, you only spend a couple of hours a week to research and invest. Unless, of course, you are a genius or a fortune teller. Another benefit of investing into an ETF is that somebody else will monitor your investments. So even if you go on holiday and don't have internet access, you will be okay. It is almost impossible for an index fund to fall to $0 because the underlying index will never fall to $0. The underlying index comprises of Australia's top 200 or 300 companies. Assuming you invest into an Australian ETF, those companies are worth something, so the index will never be worthless. If a particular company goes bankrupt, the index will kick that company out and replace that with the next best company. On the other hand, if you invest into a particular company, you have to be the person who kicks out that company from your own portfolio. And you have to know to kick the company out before it becomes worthless. Often it is mentally challenging to sell your shares when their value is half of what you paid for them. So you may keep holding them and suddenly they become completely worthless. Statistically speaking, there are many companies which go bankrupt and stop to exist over time. Business ventures are full of risks, and the business world is highly competitive. New companies replace existing companies all the time. New trends come up and old trends disappear. If the company cannot adapt to the new trend, it will disappear and your investment will become worthless. Therefore, with everything considered, the typical Australian worker will probably benefit most from investing into either an ETF or a managed fund rather than picking their own companies to invest in. And if you need to choose between an ETF or a managed fund, I would say an ETF is the better way to go.